A one-time investment of $10,000 into eBay on December 31st, 2010, held through yesterday, January 23rd, 2023, 12.1 years, would have turned $10,000 into $40,689, compared to only $31,859 at the equal investment into the SPY. Additionally, eBay did generate dividends of $2,390, which was slightly less than the S&P 500. Nevertheless, when you compare total return, income plus capital appreciation, eBay would have generated an annualized rate of return of 12.87% versus only 11% for the S&P. This has been one of the best years ever for the S&P. But one of the things that's remarkable is eBay has become very undervalued. You can see how stock price has followed earnings growth over this time, getting overvalued at times and undervalued at times. And right now we are at one of those undervalued times. So even though the S&P 500 remains fully valued to overvalued and eBay is now currently undervalued, it has actually outperformed the index over this time frame. Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, aka Mr. Valuation. Once again, it's a real pleasure to welcome you to one of my videos. This is part 2 of a series where I'm looking at putting together a dividend growth portfolio, if you will, with an emphasis on total return or maximum income. However, before I get really too into this video, I do want to make a housekeeping announcement, if you will. We've been looking into some live stream opportunities on FastGraphs. I think it could be a really great way to help serve our subscribers both to the YouTube channel as well as to the FastGraph research tool better. So I'd like to do a little poll, a little informal poll, if I will. I'd like to know, we'd be interested in doing live stream some on one day, Monday through Friday during business days, no weekends. I'm taking weekends off, thank you. The other thing is we'd like to know what time of day, and that would be between about 9:30 to 3 o'clock. That would be the time slots that we're thinking about doing it. We're going to do about a 1-hour live stream, and we're going to look at 2 ways to do these live streams. One is ways to help utilize the FastGraph research tool better. And the other way might be to, give subscribers to the YouTube channel a chance to look at, how we would use FastGraphs to analyze different companies. So we're going to have some fun with it. We don't have it completely thought out yet, but we think it's a great opportunity to help you guys understand our tool better, as well as, give us an opportunity to help you make better investment decisions. Anyway, today's video is going to be on how I construct a dividend growth portfolio. And last week, our first video, we went into, how we would use the tool to build different videos. So going back into this eBay chart again here, let's go ahead and turn to the FastGraphs. We have a screening tool, and you could run screens, and I don't have any objection to running screens. If I'm looking for 1 or 2 companies, I don't mind utilizing the screening tool because, if I'm just trying to find a company that's got a certain growth rate, a certain dividend yield, a certain historical dividend growth rate, etc., I can go into my screening tool here on FastGraphs, and I can go in and create a screen, and then I can pick things like the GIC sector, credit ratings. I can go into historic data and look at dividend growth rates, earnings growth rates, and, I can screen for that. I can go into estimated data and look for, total annualized rates of return. I'm going to explain that one a little bit better, more in the detail. But I can go ahead and create a screen, and I can play around with that screen, and I can identify, maybe the top company or 2 that I would like to like. Now, the reason I prefer using the portfolios, we have preset portfolios in FastGraph, these 15 preset portfolios. I prefer to go into these. Like I can go into the S&P 500, or I can go into the dividend challengers, champions, or contenders. I can go into simply the Dow Jones, NASDAQ 100. Let's go ahead and go into the S&P 100 large cap. The thing about it is I can look at, these are the 100, large cap stocks that the S&P tracks. I can create my screening criteria that I'm looking for. I want total annualized rate of return. I want earnings growth rates. I want to see the company have earnings growth. I want earnings yields that are above 6.5%. I do want the company to pay a dividend, and not all of these will. I want the dividends compound 10-year growth rate because I'm looking for dividend growth here. And then, of course, credit ratings and then the sector just for fun. But what I would do is I would screen these by taking these columns and sorting them. I'm going for total return on this particular video. So what I'm going to do here is I'm going to go into these 100 companies and look for companies that offer me a double-digit total annualized rate of return. And as I scroll through here, you can see that I've got several companies in this group that actually, because of valuation, are expected to generate negative rates of return. Now, the way I can look at valuation more clearly, since I brought it up, is I would go into earnings yield. And I could run this into, the worst, going up to the highest, or I could start with the highest earnings yields and move down. So this gives me a sense of where the best valuations are. But remember, I've got 100 stocks here and I'm looking for a 6%, 6.5%, minimum valuation level. And as you can see, I start running out of candidates, pretty quickly here. And I go down the list here, you can see all these names that are basically trading below that 6.5% threshold. So what I've got here is I've got an ability not just to screen with this tool, but I also have an ability to kind of get a sense of what the market value is. Now, on the S&P 500, this is even more profound. I'm just using this because it's a simple example. But one of the things I've often said is there's no substitute for going in and looking at the graph. So let's clarify that. Let's look at a company like Capital One Financial. Now, it's got the highest total annualized rate of return theoretical. That's based on some what-if scenarios, which I'll go over. However, it has expected negative earnings growth over the next couple of years. It does have a very high current blended earnings yield. It has a decent dividend yield and a very attractive 10-year growth rate, and it's a investment-grade company of financial. When I go into Capital One Financial and look at the individual stock itself, I run into some things that I don't particularly like. First of all, during the Great Recession, it had some really strong drop in earnings growth. The dividend, they actually did, pay a pretty nice dividend, but then they cut that dividend and then they froze the dividend at 20 cents for several years. So this isn't exactly a, picture of dividend growth. And this is a long-term graph. I'm really focusing on the post the Great Recession, if you will. The company showed some good growth, but that was contaminated by, a couple of, 1 year here of very high growth. When I run it down, it's kind of got average to maybe even just slightly above average growth. I've got a dividend record where they froze the dividend for several years, and then they even cut the dividend in 2020. So obviously what I would do is I would reject this company. And that's the point I want to make. It's not one that I would choose to invest in. And I would go through this same process. Wells Fargo would be another example. Once I went into the graph, I didn't like all the earnings, machinations, the drop in earnings, the cut of dividends. I just don't feel like this is a consistent enough company to qualify for what I'm looking for. Okay, so I'll go through these, but I'll look at the data here will give me a clue into what I'm looking at. Even General Motors with negative earnings growth and so on. So by going through this process and going through all these preset portfolio, the challengers, champions, contenders, I've ended up creating a portfolio where I ended up with 46 names in the portfolio. These are stocks that are still a cursory screen. I've just started out screening them. And I've, put them together. And what I've got in these 46 names are companies, that have decent total annualized rates of return. And I'm going to go through this list and I'm going to hone this down even more into a list of companies. I've ended up with 23 companies by going through that process, but I've got one in here that I'm going to reject. I want to show you how easy it is to utilize the Fast Graph tool. So what I would do is I would go through these, I would start clicking on the name, and I would look at each company. Now, Assurant, I really like the consistency of earnings growth, a little bit of weakness here, but even during then, they raised their dividend. I would go ahead and look at the company from the standpoint of operating cash flows, see if they're covering the dividend or not. I would do this with each company that I looked at here in this process. So I like Assurant. It will stay on my list right now. Applied Materials, the same. They did have some issues during the Great Recession, but they've generally put together some real good growth. They even held up pretty well during COVID, and I really like the dividend record that I see here, and I like the valuation and the fact that the company got really cheap, and it's now been recovering. So Applied Material, will continue to make the cut. And I'll just go down through the list here. Ameriprise, Broadcom, I really like the consistency of the earnings growth. Now, this is an interesting one because it does tend to trade at a 15 multiple, even though it has faster growth than that, but it's clearly trading at that and has a really nice dividend record. And if I look at it from a performance point of view, it's dramatically outperformed the S&P 500. So, Broadcom, AVGO is the symbol, is one that I like, very, very much in the portfolio that I'm trying to put together here. Now, I would continue to go through this process. This is Bank of Montreal. This is looking at it, by the way, from the standpoint of U.S. dollars, U.S. stock exchange. I just want you to know that with these Canadian companies like this, I would go into here, and because this is a duly listed company, and I can look at it from a standpoint of the Toronto Stock Exchange, and I get a little better, clearer picture of the company in its, in its own basic currency of origin, Canadian dollars, if you will. Now, next, I'm going to go into BorgWarner. Now, let's look at BorgWarner here. Looks really good. It looks pretty good if you look at it from the standpoint of the last 15 years. 14 years ago, it got reasonably valued. I noticed that. Earnings growth is a little cyclical and iffy, but, average a nice 7%. The stock is very, very inexpensive. But when I look at their dividend record, remember, I'm looking at a dividend growth portfolio. I've got a company here that's frozen its dividend for several years and expected to continue to do that. Now, that may or may not happen. Okay, but since I'm trying to come up with a dividend growth portfolio as well as a total return option, this company would meet the total return option because it's got a great margin of safety here. And again, if I go into the forecasting calculators, the number that's on that total annualized rate of return that's on the portfolio I created here, that number is simply going into the estimates tab and then pointing to the last available estimate. There's your 28.51%. If I look at the company in the portfolio, it's 28.54. There's always a little bit of a couple of decimal points difference because of timing of, the data catching up one day late, one day older, et cetera. But it's all going to be the same. But that's where that number comes from. But here's the point. When I look at BorgWarner here, I've got 23 companies in this portfolio right now. It's, if we look at it, there's 23 companies in the portfolio. I'm really only needing 20 for my own personal use. So what I can simply do here is I can click the Add Portfolio button here. It is in the dividend growth portfolio. I can just click Remove it, hit Save Changes, and now this will be taken out of this. It's no longer in the portfolio, as you see. And I kind of go through that process and, look for the companies that, that I like, that I want to keep. I looked at Comcast Corp. We talked about this last time. I use it as my kind of intro feature. And I got some questions on the last video I did on this. Does the loss of subscribers scare me? Well, concern me. Well, sure, it always concerns me, but I want to make a point. This company has very consistent historical growth. Even during COVID, it actually did pretty well. Okay, the stock price was overvalued. It's been overvalued. The market likes to put a premium valuation. In 2021 and 2022, the stock had a massive correction. And so the point I want to make is the risk of losing those subscribers is already priced in. Apparently, the stock has fallen, but the stock has already been recovering, since September of last year, October of last year, 2022. The stock, it's gone up 38%. It's at 193% annualized rate of return. So the stock is recovering. It still has a long way to go to get back to earnings. If I look at the forecasting calculator, it's followed by quite a few analysts, and they still are expecting over 8% growth over the next 3 years, which would give me just under a 21% annualized rate of return. But the point is, am I concerned about these issues? Well, this is where you go into deeper research. These are research candidates at this point. I've got 22 or 3 of them in the portfolio now. What I would do is I would go through the process. First of all, I would use the fast graph tool itself. I'm looking for dividend growth and dividend safety. So I'd go into operating cash flow, Comcast cash flow and cash flow expectations, cover the dividend well. What that means is these are the cash flows, the orange line. The white line are the dividends. And as you can see, I've got, basically $6.26 of cash flow covering $1.06 of dividends. That means that's, massive coverage. If I go into free cash flow, which is the asset test, I also have very high free cash flow coverage where I have over $4 worth of free cash flow covering just under $1 worth of dividends. So I would go through the process. I would look at the company through every metric that I have. Subscribers always ask me this. There's no reason you have them available. I can go through them this quickly and look at all these different valuation models. And then even sales, I can look at sales. Now, sales have obviously, been the trouble spot here. Sales have flat, but profitability and cash flows have continued to grow. So what I would do here is I go into external links. I happen to subscribe to Morningstar. So I would go into Morningstar and start researching the company. I've shown you this in the past. Morningstar gives it a 5-star, rating, and that's valuation oriented. I want to point their 5-star price is 42. Their fair value is 60, and the stock has closed at 40. So that's why it's given a 5-star rating. They're really saying that it's undervalued with a fair value of 60. Now, if I go back into fast graphs, using a price to sales, I would get about 53 as, the fast graph indicated fair value. Looking at it from an earnings point of view, I'd get about 54. So I'm a little more conservative perhaps than Morningstar, but Morningstar does give me some really good insights into the company. Growth will likely remain exclusive, but they remain a solidly positioned firm. Now I can go through the little menu here. I can click on the full analysis and go through the little menu here, and I can look at, first of all, do they have a moat? They say they possess a wide moat, resulting from the strength of its core cable business. Fair value and profit drivers, again, they give it a $60 fair value. They say it remains the dominant internet access provider in markets it serves, providing a solid foundation to build on. So even though some loss of subscribers might concern me, Morningstar, at least for one, thinks it's pretty solid. They do expect only modest cable revenue growth, averaging about 1% a year. That's what's got everybody concerned. They go into risk and uncertainty. They talk about technological. These are things you would monitor and watch for. Regulation, the environment, and other considerations are the biggest uncertainty from Morningstar's point of view facing Comcast. So I would go through this process and I would, research the company as closely as I can. I can also go into other sites that I subscribe to, like Zacks, go into their full analysis. They give it a neutral rating. They say 3 hold. They give it value of A, growth a B, and momentum an F. I don't necessarily agree with the momentum side for reasons I showed you before. The stock is really starting to, cover. Now, I like this. By the way, this is a way to kind of tip the scale a little bit in your favor as a value investor, is look for stocks that have had, fallen in value, and then looking for a point where they've bottomed, at least recently bottomed, and they're beginning to recover. That gives you a little bit of momentum on your side. So you might want to look at it from, that point of view. But I would go on, and I would, go into sites like Seeking Alpha. I look at, different news, what people are thinking about the company. Here's Michael Pagliaro. He says Comcast slow but steady growth can generate a good return. I think the real key with Comcast is the fact that there is a strong margin of safety. There is growth potential, and it's an A- rated company. It's a good, high quality company. And I would go through this process, and I would do this with each company that I'm looking at. eBay just started paying a dividend. I really like it a lot. Eastman Chemical, what I really like is the dividend record and the low valuation. It's a moderately cyclical company, but it actually does have good growth. And again, it is forecast to continue growing. Now, all this means when you see this, by the way, subscribers to FastGraph, that there's no analyst given a dividend estimation for 2025. That's all that means. It doesn't mean anything else other than that. So I would go through here. I go through each of these companies and go through the process, but I'm looking mainly for this consistent dividend growth, low payout ratios, low valuations with good growth going forward. That's why I'm focused on the total return aspect that I talked about. Hasbro is another one that I like. I think it's, got good future growth potential. Hewlett Packard. Now, this one concerns me a little bit with their frozen dividend for several years. So if I decided, although the stock is very inexpensive, but I also want you to notice that it normally trades at a relatively low multiple. So if I'm really being picky and really being conservative, I could go into add, remove the portfolio. And what I could do is I could take it out of this portfolio by just clicking the remove button, save the changes, and I've got rid of Hewlett Packard into the dividend growth portfolio. Anyway, I would go through this whole process. I would look at each of these companies. Here's Manpower Group. Again, I'm using a 14 or 15 year time frame here. It's got good growth. It kind of suffered a little bit during COVID, but it did maintain a nice dividend growth rate. So I like that. And I just go through the whole process. Magna ended up in some issues during COVID, but again, they maintained a very strong dividend growth rate. Analysts are expecting them to freeze it this year. That's something I would look into. Network Appliance, or NetApp as it's now called, is another good one. Owens Corning, I think, is really inexpensive. The stock has flatlined for the last several years. I believe it's got a real high margin of safety, and it's got a great long-term opportunity with a good dividend record yielding over 2.3%. Anyway, you guys get the idea. I just go through the process like this, and these would be 20 stocks that I would consider very favorably to build and construct a dividend growth portfolio for total return in today's market. And I would just go through this process. I'm always focused on valuation, but I'm also focused on dividend growth, earnings growth, and the quality of the company in question. Anyway, this has been Chuck Carnevale saying thanks for watching. Hope you enjoyed the video. If you did, ring the bell, give me a like, subscribe to the channel for sure, and take a look at subscribing to Fast Graphs. We're working on launching international stocks here very soon. There'll be some bargains coming along with that, so you might want to be a subscriber before that happens. Just a little clue or a little hint, if you will. Anyway, thanks for watching. Look forward to talking again real soon. This is how I would go approach how I could be able to construct a portfolio. This may not be suitable for all of you, but this would suit me. I like a concentrated portfolio, but I could also add 45 or 50 stocks as I showed you earlier. So anyway, thanks for watching. Talk to you guys real soon. This is part 2, the final part of this series, how to construct a dividend growth portfolio for total return. And don't forget about the live stream. Give me some feedback on what you'd like to see the live stream. Thanks.